Everyone. So today we would be taking a topic as derivatives and derivative trading. So many people are very interested or fascinated about derivatives and how to overall, either trade into it or understand it. It's not as complex as everyone thinks, but yeah, you need to be a little bit more careful before or new know certain invoices or things which will impact your overall trades before you enter into a derivative segment. So first we need to first and foremost understand what is derivatives. So many of us have a conception that derivative is a financial instrument. It's not a financial instrument. It is basically a contract. Uh, say you can say it is a contract between a buyer and a seller. When that contract you enter into a contract, it becomes a financial instrument which derives its value from some other instrument. Okay, so say for an simple example, if you have a derivative on index or say on Nifty, so on its own that derivative would not have any value. It will derive its value from Nifty itself or an index itself. And when you enter into a contract, that becomes a contract between a buyer and a seller. So it is basically a contract which derives its value from some other standalone or some other financial instrument. And in order to do that, it has to get into a contract between a buyer and a seller. And its movement will also depend on the movement of the underlining, which we call, or the underlining from which it derives its value. So basically, on which asset the derivative is based is known as an underlining. So there can be many number of underlinings going forward. We will learn one by one, but it can be an equity index, an equity stock, a commodity, gold, silver, oil, or even agricultural based commodities such as soybean, corn, coffee, or even wheat. It can be instruments like bonds. So n number of instruments can be used as an underlining to create derivative. So major derivatives which we have here in the Indian market or in the global market are basically on either the precious metals, that is gold, silver, then on base metals such as aluminium, steel, copper, then on energy indexes such as gas, crude oil, coal, agri commodities, which would include corn, then soya, coffee. Then in the financial instruments, it can be an stock, it can be an index, it can be an interest rate derivative or a bond. So these are the basic broad underlinings which currently have their derivatives on. And most of them are exchange traded or exchange regulated. In the fixed income market or in the bond market is where you would find exchange regulated also and over the counter traded instruments also. But it is always prudent to stay with exchange regulated derivatives so that in case if there is something which we don't want or something which has happened which is unethical, the exchange backing would always be there. So why do we have derivatives first of all, please? When it does not have its own value, it derives value from something else. Then why do we require derivative? Now, a major reason for derivatives to come in is basically it's a mechanism which allows you to transfer your risk from the risk avoider to risk seeker. Now, how does it do that? In the traditional market, you either buy securities or you sell securities which you already have. But there is no mechanism to sell securities which you don't hold. And that is where derivatives came into existence. It allowed you to short a security before even you hold them. And that helped in a better price mechanism or price discovery mechanism. So for example, if I have a particular security, which I want to keep it in an underlining format, but for a very short period of time, I would want to avoid risk. So a beautiful example to understand is on the current scenario of say such uncertainties in and a scenario where you have a war going on, you want to avoid high risk instruments like equities, but you don't want to sell your portfolio entirely. You want to reduce the risk. So derivatives will allow you to do that in n number of ways where you can reduce your risk and transfer your risk and become a risk averse investor or risk avoiding investor to the investor who is willing to take a risk at that particular moment or at that current moment and would take your counter position. Thus this is where derivatives had been started. So if we just look at a very small history of how this entire concept came into existence. So in the early 16th century in Japan, where derivative markets were born, the early or we may say non-exchange regulated derivative markets. It was basically the samurai traders or the samurai fighters. They were at that particular point paid in amount of rice, and to then they used to barter that rice for money, and then they used to do that trading because they used to be on the go, and at that particular point of time they were paid in rice. So to mitigate their risk of rice, because when they were on the go it would have been in harvesting season, and by the end they come it would be in season where rice was completely harvested, it was taken out and it was into the market, so price used to fluctuate a lot. So to save themselves from this fluctuation, they used to pre-trade their rise earnings and save their fluctuation. So this is how the entire concept developed, and then slowly it was taken into the London Exchange, that is LME, which currently is there, to CBOE, that is Chicago Board of Exchange, where we have now standardized derivatives. Those were the two premier exchanges which standardized the derivatives in an exchange format. Now, what were the types of derivative contracts? Excuse me. So, what were the type of derivative contracts that came into existence? So, if you see, there are two major contracts or two main contracts. First is a future. A future contract is basically nothing but an agreement between the buyer and seller to either buy or sell that specified underlining at a fixed price at a specified date. Okay, so why it is important to have an exchange back or standardized contract? Because when you enter into this contract, these things are predefined by the exchanges. So futures contract will always be standardized and it will be traded on the exchange. So at any given point of time, you will have a counterparty in terms of exchange. You will have quotes which will be shared by the exchanges, where you have buyer and seller quotes, where before the contract gets listed on the exchange, the dates are prefixed and the quantity is prefixed, and then you enter into the time price which gets fixed as the buyer and seller quote matches. Now, then the second contract is basically an option contract. So option contract gives the option buyer. Now you need to understand this, that option buyer would get a right to either buy or sell that underlying asset at a particular price which is also prefixed at a particular within a particular stipulated time, that is the expiry for that contract is prefixed and the quantity is also prefixed. So that is how the options are overall structured by the exchanges. Now for options, there is two more subdivisions. One is a call option and a put option. The major difference between this is, if you are a buyer of a call option, it will give you a right to buy that particular underlining. And if you are a buyer of a put option, it will give you a right to sell that particular underlining. So that is a major difference between a call option and a put option. So in types of derivative contracts, what we have is basically a futures, which similarly acts as what you would be doing into equity trading. Similar thing is there where you are a buyer, you buy it, or you are a seller if you want to sell it. Then you come to options. So in the options, either you can be a buyer of a call option where you want to buy that particular underlining, or you are a buyer of a put option if you want to sell that particular underlining. Obviously, there will always be counterparties to it, but right now we'll just stick to this so that the understanding becomes easier. And as we flow into the presentation, we will take the counterparty side also. Now, now let's come to the one of the most frequently talked about derivatives, which is equity based derivatives, which would be stock based or even index based. Now, equity based derivatives, as we have learned that derivatives needs an underlining to find its own value. Okay, so here the underlining would be the equity share, and we would have a price specified in the futures market for that equity share to be bought or sold, and that price will depend on how the equity share moves. So if the equity share goes up, the future price would go up. If the equity share goes down, the future price would go down. Similar movements would come into the option prices also. So the underlining here would be the unequity share in the unequity markets. Now, you will have options also where you would have different prices of options, strike prices, which we call, or predefined prices for that options, which will also move based on the underlining of the underlining, which will be governing the price of that particular option. Similarly, indexes are also traded in the futures segment. So equity index based futures will have underlinings of the most common traded indexes would be your Nifty index. So you'll have Nifty futures, you have Bank Nifty futures. These are the two most common traded equity indexes. Even similarly, you have Sensex futures also, and plus you have options available for different time period for Nifty, Bank Nifty, Sensex, Nifty Mid Cap. N number of indices are there. Financial Nifty also is there. Even in Sensex also you have Sensex 50 and all. So those kind of indexes will act as an underlining for the index based equity derivatives. Now to move a little bit inside the index-based derivatives, we'll take Nifty 50 to understand the basic structure. Generally, NSE has and similar expiries for Nifty as well as Bank Nifty. So whatever we talk here for Bank Nifty would be relevant for Nifty in whatever we'll be talking here for Nifty would be relevant for even Bank Nifty. So for an index expiry, you generally have three monthly expiries. One is the near month. So today was the March month expiry, which was the current month expiry. Then you have the near month, the next month, and the far month. Now, since today we had an expiry, tomorrow a contract will open. That means that you will be having the next month, which is the April month, which was next for the March expiry, will become your near month. The far month, which was May, would become the next month, and a new far month contract will get open. That will be the June month. So at any given particular point of time, you will have three monthly contracts open, which is near, next, and far. So from tomorrow, you will have April, May, and June. Like today, when the trading hours were going, you had March, April, and May. But then in the futures, what we have that last Thursday would be expiry. So today was the last Thursday for the March month. So today was the expiry day for Nifty, Bank Nifty, and other index futures contract. So at the start we said that index exchanges have standardized these contracts. So the contract expiry date is standardized. That is the last Thursday of the every month. Futures contract will expire. Then the lot sizes are standardized. Say for example, the amount for Nifty is 50. For Bank Nifty it is 25. So that way the lot sizes or the contract size is standardized. The minimum contract size is 5 lakh. So that is also standardized. Sometimes it is there that the contract sizes at a particular given of point due to moves in the indexes go beyond a reach of 5 lakh or even more. So earlier the contract size for Nifty was 75, but since Nifty was had moved up significantly, that the contract size had gone beyond 8 or 9 lakh, it was brought down by reducing the contract size to 50, so that it again ranges in the near to the minimum lot size. But these changes are done at either in a fixed formula by exchanges where periodically, that is quarterly, they review that. And then minimum price step is also fixed, that 5 paise is a minimum incremental price step for the Nifty. Now, if we go to the index options, the the expiries change a little bit, because for index options, specifically for Nifty, we have leaps also available. Now, what is leaps? Is a longer equity anticipated contracts, which we call as leaps. So you have a very long duration. So at any given point of time, you would have 4-year tenures available in the option cycle, which is as short as 1 week and as long as 4 years. So how it is? You have 7 weekly and contracts available at any given particular point of time. So for example, you would have 4 current month contracts. So from tomorrow, you will have 4 April weekly expiries and 3 next month weekly expiries coming in. Then consecutively 3 monthly contracts are there. That is April, last Thursday of the April, last Thursday of May, and last Thursday of June. After that, you have 3 quarterly months contract open at any given particular point. So today was a closing of a quarterly month also. So now March has been closed. So that means you would be having next 3 quarter expiries open. That is June, September and December. After that, you would be having following by 8 semi-annual month cycles, which will be June and December. So 8 semi-annual expiries would basically give you a tenure of 4 years. So basically, this new weekly options which have been introduced have been in addition to the monthly, quarterly and the half-yearly contracts. So these strikes will be introduced for both the call option and the put option contracts. And last Thursday of the week would be the weekly contract expiry. Last Thursday of the month would be the monthly, quarterly, and as well as semi-annual expiries. So basically today would be an expiry for the December month, which would also become an 3 quarterly expiry. So the March quarterly expiry also happened today. And the June last Thursday would mean that it would be an expiry for the June monthly as well as biannual or semi-annual expiry. Again, if that last Thursday is a trading holiday, this is also prefixed by the exchanges, then the Wednesday before that Thursday, so a day before, would be the expiry for that particular contract. So before entering or before the contract opens, you would be very certain about the expiry date, the contract size, that is the number of shares, as well as the minimum lot size of that contract. Now let's move on to another widely traded derivative, which is currency derivative. Now currency derivatives is globally the most traded derivative. It is also very widely traded in the Indian markets. But a little bit further, you need to understand if you move to the currency derivative. The reason you need to understand a little bit more deeper into a currency derivative is that because it would always involve two pairs of currency as compared to an equity or an index derivative where the underlying was either a single stock or a single index. Say for example, if you have an USD INR, which is one of the most frequently traded currency in India, it would involve two currencies, that is the dollar as well as the INR, and the combined rate of USD INR which would be given to you. But this underlying rate would get impacted on two aspects, or two economies will influence this rate. The US economy as well as the Indian economy would have its influence, plus the global overall situations will also have its influence. Say for example, the recent war scenario, it gives a very good case study why when you are investing into currency, you need to look at a global scenario more also than only to the residing country where you are trading. As the overall Ukraine was invaded by Russia, most of the dollar INR pair or euro INR or yen INR, these all currencies went up or shot up. Neither US was involved, or indirectly it was involved. Directly, neither US was involved nor India was involved. Neither the European countries were involved nor the Japanese countries were involved. But the global trades do impact the overall USD INR trade also. So how your underlining will move would not only depend upon the domestic factors, but also on the global factors. Whenever you are entering into any derivative, the most important thing to understand is what factors can move my underlying. If you are very comfortable on that and you have a pretty good hold on that, then you would be able to trade into that derivative a little bit more better than just entering in without understanding the overall dynamics. Now we move to another type of derivative, which is the interest rate derivatives. Now this interest rate derivatives uh, structure, or to understand how this underlining moves, it also has a little bit of an global impact, but it has to be more done, or it will be more impacted to the overall macro and microeconomical structure of the deciding country. So here we'll take India, since we would be talking about the more of the Indian interest rate derivatives. It is basically a contract between the buyer and a seller on the notional security or any interest rate bearing instrument which is issued by the government of India. That can be a normal, a bond, a short-term bond, or even an interest rate instrument, or a treasury bill, or even the MIBOR, which is the Mumbai Interbank overnight rate, which is similar to the LIBOR, which is used globally. So that overnight rates, these all instruments are will be acting as your underlining for the interest rate derivative futures segment. When you come to the interest rate option segment, the underlining moves, or it shifts from not the bonds but the actual interest rates. Okay, this is one thing which is different than compared to what we have seen till now in the currency derivative or in the equity or in the index derivative. In the equity, currency, or index derivative, the underlying still remains the currency or the equity or the index. But when you have interest rate options, it generally shifts to the interest rate option contracts which are available with the government of India. So basically, it becomes the interest rate, that is the 6% interest rate option, or 6.25% interest rate option, or 6.5% interest rate option. It does not become the 6.5% 10-year government of India security as an underlining, but only the interest rate becomes the underlining for that option. So how the interest rate moves, the interest rate options move accordingly. And also it will change depending on the tenure you take. And the underlying tenure would be say a shorter term, a 30-day or a 60-day or a 90-day or a 180-day or a 360-day or a 5-year. So that kind of way it will overall move how that interest rate option will react, because it is on a different rate curve, or you can say on the curve of interest rate curve, it would be landing on a different duration. So a little bit more deeper insight, it's to be understood that how that interest rate would, or interest rate option would react if the longer term interest rates are increased and the shorter term interest rates are stayed where it is. Then your 6.5% 30-day contract might not react much. That option might not react much, but a 6.5% 180-day option contract might react, because on the duration the move has been there on the longer side and not on the shorter side. So this is kind of a things you need to understand before you enter into any derivative instrument. That is the reason at the start of my presentation I told that when you are entering into any derivative contract, please understand that how your underlying gets impacted. Now we come to another interesting concept or another interesting underlining, which are the commodities. Now, these are also globally impacted and locally also impacted. And the impacts can be of a varying degree. Now, to have a very simple understanding, I'll give you an example of two commodities. One which is very highly impacted by global factors, which is your crude oil. Now, everyone knows that crude oil will impact if even if there is an excess supply by the crude producing nations, that is the Middle East. If they increase the supply, then that impacts the crude prices. Also, if there is an excess consumption of crude in the bigger markets like US and China, the crude prices impact, and that crude price will also see reflection into the crude Indian futures. So this is where you can see that global consumption, global supply demand impacting your Indian futures market also. Similarly, a second example I'll give you is of sugar futures. Now, if you have an excess supply of sugar in the Indian market, since we are one of the largest producers of the sugar, you will see Indian sugar prices impacting and global sugar prices also impacting. But say for particular price, say that because of a drought in Brazil and Indian sugar's exports have increased, you may see a reverse impact to the global sugar prices. Global sugar prices may have stayed there and there, but since we are exporting and there is much of a demand for sugar in the Indian market, the Indian sugar futures increase, and the gap between the global sugar price and Indian sugar prices have come down. So it is not that only global things impact, but even local market scenarios also impact your underlyings. Still, the concept remains same, that the underlying asset will move your derivative, and even the underlying asset in the commodities will act as the underlying for the options also. It is only interest rate which has that difference, otherwise it is one and the same. So basically, whatever underlying maybe be it crude oil or sugar or gold or copper or corn, whatever it is, it will act as an underlying, and that movement in that underlying will decide how the movement happens in the commodity futures segment also. So now let's talk about few basic terms. So in the options thing, what we had already learned, that when you are a buyer of an option, your price is predetermined, your quantity is predetermined, and either you would be buying that underlying or selling that underlying is predefined. So for example, if you are a buyer of a call option, at what price you will be buying, which is predefined, would be known as the strike price. Okay, so at that particular price, in would be buying that underlining. But if you are buyer of a put option, the strike price will be the price at which you would be selling your stocks or your underlining on or before the expiry date. Okay, so the exchanges have predefined strike prices, and the strike prices will be ranging from, say for example, if a stock is quoting at around 1500, you will have strike prices which would be from 1200 to as well as around 1400 or 1500 or 1700 also. So that different varieties of strike prices would be available at a predetermined intervals. So that intervals can be 5, 10, 50, 100, 2.5, depending upon the price of that stock. The exchange defines the expiry date, which we already know. Now, exchange also defines that, will that option be an European option or an American option? We don't need to get confused by the names of European option or an American option. It basically means if you're holding a European option, you can exercise your right, that is to buy that particular stock or sell that particular stock only on the expiry date. Well, if it's an American option, you can exercise your right from the day you entered the contract till the expiry date. Now, let's understand this very simply on a conceptual base through an example of an insurance. Say, for example, you have bought and life insurance. Life insurance would be categorized as a European option because you can only claim that life insurance at an event of a death. Okay, before death you cannot claim. Say, for example, if you have bought a term policy for this particular year, if in this year if you are not dead, you would be not going and claiming your life insurance. So the premium goes waste and you are not claiming your right. If anything happens, you can claim your right. So it basically on that particular event or on that particular date only you can claim. So that would be categorized as an American option. Contradictory, if you say are buying, sorry, a European option. Contradictory, say if you are buying medical insurance. Medical insurance would be that from the date you have entered the contract till the expiry date, anytime any medical emergency comes, you can exercise your right. That is called like an American option. But in India, most of your equity options are European. Currency and commodities might have American options also. Now, other thing is contract value. Now, contract value is nothing but the notional value of that contract. That is that your number of shares multiplied by the value would be your contract value. Ma'am, my voice is clearly audible because I can see few chats saying the voice is very low.
So I can hear your voice.
Okay, it's clear, right?
Yes, it is.
Okay, okay. I still try to be a little more louder. Yeah, and basically contract value is nothing but the number of shares multiplied by the share price, which will be your notional contract value. So, for example, say Nifty value is at 17,500 approx, and the contract shares are 50. So, if you multiply 17,500 multiplied by 50, will be your notional contract value. So buyer of a call option and a buyer of a put option, basically whenever you are buyer, you would be paying a particular option premium to buy that particular right. Now we'll come to an important concept, which is the counterparties to the buyer of a call option or a put option, which we say seller or a writer. Okay, so the writer of a call option or a put option basically agrees to be the counterparty to the buyer. So again, we'll just move to the insurance example to make it a little bit more clear on the concept side. You would be the buyer of the insurance the insurance company would be the counterparty or the writer of that particular option. So whenever you exercise your right, the insurance company is liable to pay you the amount for what you had insured. Okay. So whenever you exercise your right as a buyer of a call option, the seller of the call option is liable to give you or sell those shares to you at that predetermined price. Okay. So you would be paying a premium to take that insurance. If nothing happens, your premium goes waste, and that would be the income for the insurance company. Similarly, you pay a premium to buy that right. If that you don't exercise your right, your premium becomes zero, and that is the income for the option writer or the call seller. So basically, that is the counterparty. Your counterparty can always be thought as the insurance company, and the buyer can anytime can be thought as an insurance buyer to make it a little bit more easier to understand the concept of the option writer. Now, the option price or the premium that will have two basic components. First would be the intrinsic value, and the second would be time value. Now, if you just move this again to the insurance premium, what you pay, the intrinsic value would be basically the health what you have at that particular point of time. The better the health, the lower the premium would be. Say for example, if you are if a person is a smoker, he would have to pay an additional premium. If someone has a heart disease or critical illnesses, he might have to pay a higher premium. But if someone is very healthy, a non-smoker, non-drinker, his premium would be lower. So that is your intrinsic value or the minimum value. Then would be the another value, that is time value, what age you are at. And person who is at the age of 20 would have a lower premium, but a person at the age of 60 would have a higher premium. So similarly, option prices are also calculated. If your strike price has some intrinsic value, which gives you an advantage at a particular when you are entering into it, so that intrinsic value you have to pay, so that at the time of entering the contract, neither the buyer nor the seller is at an advantage. So to understand that in an example format, say for example, if I'm buying and call of 1,000 rupees, where I have a right to buy that shares at 1,000, but the current price of that share is 1,100. That means when I'll be entering into the contract, I would be making a profit of 100 rupees, because I can sell that particular share at 1,100 in the market, while I'm having a right to buy that at particular 1,000. So that means the seller would be at a disadvantage of 100 rupees. So to negate that advantage, the minimum value for that option would be 100. The buyer has to pay minimum 100 to compensate that seller, to entice him to enter into that contract. Now, how much time is remaining would be the additional premium which the buyer has to pay to buy that particular time. So that will be intrinsic value plus time value. Now the time value would slowly decrease as you near the maturity, as the probability of that particular price coming will be reducing. So this brings up to another concept, which is moneyness of the option. So intrinsic value would always be there when the option is in the money. And when the option is said to be in the money, when at the time of entering into that contract, it would have a positive value. Like in our previous example, when the current price is at 1,100 and if I'm buying at 1,000, that means I have 100 positive value. That means my intrinsic value is 100. But say if I have an option or a right to sell that particular shares at 1,000, but if that share is trading at 900, that means still I am having a positive value of 100. So my intrinsic value would again remain 100. Okay. So whenever there is an intrinsic value, that means that option is in the money. When there is no intrinsic value or negative intrinsic value, that means that option is out of the money. And when the current price and the strike price are same, we say that that option is at the money. Now, once we put this concept for calls and put, whenever you see and current price is higher than the strike price, when your current price is higher than your strike price, that would have an intrinsic value for a call option. That means it will be in the money. Similarly, when your current price is lower than your strike price, in our example which we said, when I can sell that particular share at 1000, that means I've bought a put option which gives me a right to sell that share at 1000, but the current price is 900. That means my current price is less than my stock price. I have an intrinsic value and that option is in the money. For out of the money, it is reverse. That means your spot price or your current price is less than your strike price, and that means my call option is out of the money. Say for example, if I have bought and right to buy that particular shares at 1100, well currently if it is trading at 1000, that means my call option is out of the money. So this would be an very important concept for option trading. Now another important concept for futures and options both, this mainly is for futures, is open interest. Now, what is open interest? Open interest is nothing but one open position into the market which would comprise of both a buyer and a seller. Say for example, buyer A and seller B both enter into an futures contract or an option contract, whichever contract they enter, but they enter into a derivative contract, let's say like that. So that means there is one open interest into the market. Say for example, we just see. Okay. Yeah. So if you can see my screen, what it says that A entered into a buy. So we can say A, which was on the positive side, and B is on the negative side. Okay. Now C also enters with 5 positions on the buy side. So we'll say plus 5 for C and 1 for A, and you have D which has negative 5. So this, if you total in, this is 1 open interest, this is 5 open interest. So your total will be 6. Okay. Now say for example, A sells this. So we neutralize A. This has gone out. Okay. And D also neutralizes 1. So D has come down from 5 to 'D has come down from 5 to 4. So now this from 6 shifts to 5. So now we have 5 positions which are open in the market. Okay. Now the next day, what we see is that E, so now let's say we are at 5 open interest total, Now, where C had 5 positions, B had 1 and D had 1. Okay. Now E buys 5 positions. So 5 positions which E buys, and C closes its positions. Okay, so still your total would not change because E has just replaced C. So C has been replaced by E. So still the open interest will stand at 5. Now when all these things are happening, it is important to note that when this buying and selling happens, how the overall price moves. So that movement of price will give you an indication of overall trend for that stock. So this is how you totally calculate open interest. You would have been frequently, listening that, open interest in this stock has gone up, this stock has gone down. So, and the prices have moved up or prices have come down. So how that price movement with open interest overall impacts the trend for that stock. So when you have increase in price, I don't know, I'm not able to again write it. Okay, so when you have increase in price with increase in open interest, that shows that when the buyers were adding their positions, the prices went up. That means the buyers were much more aggressive compared to the sellers, which shows that there was overall long built up into the stock, and this means that the long positions were built up, and from here we can say that the prices of that particular stock would go up, or there are chances of the prices to go up. When you see the prices were prices were open interest was increasing and the prices were decreasing. Previously, we had prices were also increasing, open interest was also increasing. But when open interest goes up, but the prices went down, that means the sellers were much more aggressive, and you can say the trend for that stock would be going down. When the inverse happens, that open interest decreases and prices keep on increasing. That means those who had already built their short positions are now covering it up. So that means that there may be in the near term, the downtrend may come to an end. So that is one where, you can say a trend may reverse. Similarly, when the open interest also reduces and prices also go down, that means those who had already built their long positions previously when the open interest went up and the prices went up, now it is coming down. They are unwinding their long positions. So this means that the uptrend may end nearly. So this is an important concept to understand before trading into derivatives. Now, how to trade into derivatives? To trade into derivatives, you don't need much. You need to open a trading account. If you most of these days you open a 3-in-1 account where the trading demat account and bank account are open together. But if not, you also can open your trading account and link your DP account to that trading account. You need to select the exchange, the derivative segment where you need to trade. and then you can start your trading. Minimum net worth to trade into derivatives is 2 lakhs, which is set by the SEBI and the exchanges. Then you select your stocks or the underlining or the contracts, and you choose your expiries and enter into the trade. And whenever you feel that your trade is making good amount of profits and you want to close your positions, you can enter into and opposite position to settle your trade. Or whenever you feel that no the trade has not worked in your favor and you want to close it out, you can also enter into an opposite trade and close out that positions. Now, option pricing. Now, the option pricing, as I told you, the two critical factors which decide the option pricing is nothing but your intrinsic value and your time value. Now, time value would again have one more factor which will impact the time value, is nothing but your volatility of the underlying asset and overall also the interest rate. These two will also impact your time value. So there is an most famous pricing model which is used very frequently is the Black and Scholes option pricing model. It does nothing but it factors into the risk-free interest rate, then the time to expiration, the volatility of that particular index, and the current spot price of the underlying, and then it does a discounting factor, or you can say time value discounting with these factors, and then an option pricing is arrived. So trading into the futures segment, it's basically similar to it's a linear payoff similar to your equities, where the amount of the stock increases, your profit increases, the amount of the stock declines, your profits decline. So potentially there is an unlimited upside and a downside. However, in options, if you are a buyer, your potential downside would be limited to the amount of premium. But if you are a seller of an option, it is inverse. Your potential upside or your potential profit is limited, but your potential downside is unlimited. So that one needs to take into account before trading into options. Moreover, on the selling of options. On the part of taxation, though I am not a tax expert, but still basic taxations which were there prior to 2005 and 6, all the derivative contracts or your income were considered as speculative income. But after 2006, the Income Tax Act has made that amendment, and now trades could be offset against the other speculative income, and also the transactions have an offset of their income. So the losses of the derivatives of futures segment can be adjusted against the other sources of income. The only source which is not allowed is the salary income. So if you are a salaried person, against your salaried income, you cannot adjust your derivative losses. So that is one exception which they have kept. Other than your other business incomes, this would be also considered as your business income. Overall, the STT what you pay also will allow you deductions in your transactions or your secure other taxes. Your deductions are available which on the STT which you are deducted in your derivative transaction. So that offset is also now available prior to post 2006. Things one needs to remember carefully, which I've been reiterating throughout my presentation. It needs a lot more understanding of how the underlying would be moving. You need to do your own research. Ma'am in his presentation also had told that don't rely on unsolicited advices. Do your own research, and investments back through your own research would be much more fruitful. For that, you need to understand the dynamics of the markets which are involved, how the underlying asset would be moving, which aspects can affect your underlying instrument or your underlying asset, be it global, local, micro, macroeconomic factors. Also, professional qualified professional advices can be taken if you need it. And also before commencing the trades, you should understand all the charges which might be included. Say for the futures and option, STT charges varies if you are squaring off through the market, or if you are exercising your right, the STT differs. So all those exchange charges need to be understood before entering into the trades. And please always trade through exchange registered or semi-registered brokers only, and not through unregistered brokers. Also, derivatives are we can say leveraged instruments. So you need to have sufficient funds into your account before you trade into derivative segments, because the movement in derivative might require you to deposit additional amounts as margins or securities to hold on to your trades. So it would be always prudent to have funds in excess of the initial margin requirement. And if you are very new to the market, it would be prudent that you start with products like mutual fund, where your risks are diversified much more. Gain experience through mutual funds, then through equity instrument investments, buying stocks for some particular point. And when you are confident enough, then only enter into the derivative market. As you know, the market is dominated by very sophisticated algos, also machine trades also. And if by any chance you make any mistake, that advantage would be taken very swiftly and very harshly, and then consequences can be that there can be huge losses. So please be very informed before entering into the derivative segment. So ma'am, that's it. Now I'll hand it over to you. We can open the floor for Q&A.
Thank you, Mr. Vora, for your presentation on derivatives. Now comes the time. Hello.
Yeah.
Now comes the time for our question answer session. So I will just see the chat box and go one by one with the questions. If you have any further questions, you can go ahead and type it out in the chat. So, sir, I will take the first question.
Yeah.
There is a question from Mr. Nagaveni, which says, sir, if one buyer is there, one seller must be there. In the beginning of the month, new contract, who is seller for? Is seller? No, sir, I just read that again.
Okay,
If one buyer is there, one
yeah,
seller must be
this
there.
question. It is not that exchange is the seller. Derivative contracts, you are allowed to short a particular security even if you are not holding. So it is market participants who would be the buyer and the seller. So someone would be taking a short position, while if you are taking a long position, someone else would be taking a short position. That is the reason it is called one open interest. It is not that exchange would be the seller.
So the next question again is from him. It says, I have pledged shares NSDL as collateral for trading in futures. Still broking. NSDL shares are not available actually. Maybe he would. Mr. Nagabeni, can you unmute yourself and ask the second question?
Madam, certified companies shares have pledged, say Reliance, L&T, Ultratech, like that. Certified company shares have pledged with the NSDL as a collateral for trading.
For margin, you're saying, okay.
Yeah, margin amount.
Okay.
So still broker is demanding 50% cash margin. Is it to be required?
Yes.
Mr. Vora?
Yeah. So, sir, recently NS exchanges have introduced a rule where 50% cash and 50% collateral is required. However, it is yet not implemented. But most of the brokers are moving towards that rule, so that in a month or two when it gets implemented, the clients have sufficient amount of margins, and that is the reason the brokers are now taking 50% as stock margin and 50% as cash margins.
But still it is not implemented, is it not, sir?
It is not implemented, or still the deadlines were extended, but
Yes.
it cannot be that if it gets implemented from tomorrow, then I ask you that you either deposit 50% cash margin or close your position. So to stay compliant enough, they have already started to implement that, and started to ask clients to comply with it, so that it doesn't become a rush when it that implementation happens, because
But
it
my,
has to get
my
implemented.
sorry, sir. My broker is charging interest. I have shown the SEBI circulars also. In spite of that, he is charging interest and he is not responding. Why you are charging? On what basis you are charging? Tell me like that. I am asking.
So I guess, ma'am, you can take ahead if they are not, broker is not responding. I guess previously they had given a slide where you can even write to SEBI and scores or something it was. So you need to clarify with your broker first that how the interest cost is levied on you. Is it on the 50% of the future margin or not? And if you don't get a satisfactory reply, I guess then you can even write down to SEBI to understand it.
Can I complain with SEBI, sir? Can I raise
Yes.
a complaint with SEBI, sir?
You can raise your query with the exchanges also to understand. And if not, then you can take it ahead also.
From last 3 years, he is charging interest for me.
So that's what I'm telling you, sir. You need to first understand with your broker that on what is he leaving interest on the leverage which he is providing you on the 50% of your futures margin or cash margin, what that interest component is. And then accordingly, you need to see if that is allowed by the exchanges or not, and then you can raise a matter with the exchanges also.
Okay, thank you, sir.
So there's a last question from Mr. Ashish, which says, if I am a commodity buyer and if my call price is less than the strike price, then will my price for that commodity be accepted or declined?
See, call option, that call price which you are talking is the strike price. So if your strike price, also, Mr. Ashish, if you can just unmute and ask, because you have written call price as well as strike price.
Mr. Ashish, can you unmute and question?
Yeah, hello.
Yes, sir.
Yes, so I was just trying to understand that if my the oil price, which is the also known as the buy price for a particular commodity, if I quote that price which is lesser than the strike price, then will that price for that commodity be accepted or declined by uh,
By
the,
the
the
by the
merchant?
term call price, do you mean the commodity price, or
Sorry, I'm not able to hear you.
by the term call price, do you mean the commodity price?
Yeah, for a particular commodity. Uh,
So, for example, a particular commodity is trading at 100 rupees, and if your strike price is at 90, so then will your price be accepted? Is what you are asking?
Yeah, if I quote some example 85 rupees that time, then
So, but why would you quote that? Is my question.
because I'm calling for that price, no, prior to the strike price.
No, you want to buy a particular stock at 90 when it is trading at 100. So you would, if you will say you are quoting 14 rupees, that means you are paying 90 plus 14, which is 104. So it will be accepted. Why it will not be accepted?
Oh, okay, okay. Yes, I just wanted to know.
Anything if you say you will be quoting 8 rupees, so that means 90 plus 8 would be 98. So someone would not be willing to sell you at 98 when he can easily sell it at 100 in the market. So the price would go into the system, but you might not get executed.
Yes, that is what I wanted to understand. Will I be able to execute on that amount?
No, it will not get executed because logically, if you can sell a particular commodity at 100 in the market, why would you sell it for 98?
Okay, okay. All right. I got that. Thank you.